Before starting the video, click the subscribe button and turn on the notification bell. Hello and welcome to House of Commerce. So in today's lecture we are going to discuss about cost and revaluation model of fixed assets, about the meaning, their accounting treatment and journal entries. So watch the video till end so that you may come to know about cost and revaluation model step by step. Revaluation of fixed assets is a process by which the carrying value of fixed asset is adjusted upward or downward according to the market value. So there are two things in which we measure an asset, a fixed asset. It can be a cost model, it can be a revaluation model. So what happens in the cost model? Let us discuss about this. In cost model, the carrying value of the fixed asset equals their historical cost less the accumulated depreciation or accumulated impairment loss. There is no upward adjustments to the value due to the changing circumstances, as the cost at which the assets is purchased, it shall be recorded on the same value till the end of the life of the asset, and it shall be depreciated accordingly due to the changes in its value according to the changes in the time. For example, X Limited purchased a building for $200,000 on January 1st, 2008. It records the same building using the following journal entry: equipment debit by $200,000 and cash credit by $200,000. Hope you all know about such entries, which are called journal entries. So the building has a useful life of 20 years and the company uses the straight line depreciation method. So whoever does not know about how to calculate the depreciation, they may watch the video in which we discussed at how to calculate the depreciation by using different types of methods. So one of the method is a straight line method, by which the company calculates the depreciation. Yearly depreciation is hence 200,000 divided by 20 or 10,000. So the asset's cost divided by its total useful life of 20 years. So it shall give us $10,000. Accumulated depreciation as at 31st December 2010 is 10,000 into 3. So by passing 3 years, it shall have 30,000 of depreciation. And the carrying amount is $200,000 minus 30,000, which equals to 170,000. Now, the asset has a book value of 170,000. So we shall record it at 170,000 instead of the revaluation amount. So this is called cost model. Now let's come to the revaluation model. So most of you, the listeners, might have the idea about what is revaluation, but the newcomers who have come to know about this word for the first time, they must have the idea before doing the depreciation and while studying the fixed assets and all. So revaluation model and cost model is different because the cost model only allows the depreciation or decline in the value of the fixed asset, but revaluation might have the upward trend or downward trend in its value, in the value of fixed asset. How? That you have used your asset for 3 years and you have depreciated by deducting the depreciation of the same asset, but it might have more fair value in the market than your books. So your asset might cause an increase in its value, or the market value is less than your book value, so it might cause a decline in its value. So this is called revaluation model, that your asset might have the upward or downward trend in its value as compared to the market value of the same asset. Okay, let us take the example of the same asset which we used in the cost model. That a company uses the cost model at a start and it has an asset of $200,000 and it was depreciated by $30,000. Now it has the book value of $170,000, and the fair market value of the asset on the same day at the end of third year, it is $190,000. Now the fair value is exceeding the current value or the carrying amount of the asset by $20,000. Now this is a revaluation surplus upward. So what shall be the treatment of this, and what shall be the entry? Now let us take a look. Now entry to record this is building debit, as there is an increase into the value of the building. So the asset shall be increased and it shall be debited. So building debit and revaluation surplus shall be credited. Now you must note that revaluation is a part of equity as well. So it shall not be taken as a normal gain. Now let's read this out, that revaluation surplus. Upward revaluation is not considered a normal gain and is not recorded in income statement. Rather, it is directly credited to the shareholders' equity, called the revaluation surplus. So revaluation surplus holds all the upward revaluations of the company's assets until those assets are not disposed of. So revaluation is a part of equity, and it shall debit the asset, it shall increase the asset, and it shall not be recorded as income into the income statement. Now what will happen if we want to charge the depreciation on the revalued asset? So depreciation on revalued asset shall be applied on the revalued amount, and you have to keep in knowledge that the years taken for the depreciation, the useful life taken for the depreciation, shall be the leftover or the remaining life of the asset which was at the time of revaluation. For example, depreciation in period after revaluation is based on the revalued amount. In case of X Limited, depreciation for 2011 shall be the carrying amount divided by the remaining useful life. So 190,000 is the revalued amount and 17 years is the remaining useful life of an asset. So the depreciation shall be equal to 11,176. Now reversal of revaluation. If an asset is subsequently revalued and it is compared to the market value, so if it is declining its book value or it is below its book value, so what will happen, that we will record it as a reversal of revaluation. But if the revaluation now exceeds the total revaluation which was before, so the difference between the revaluations before and now, it shall be called as impairment loss. So what will happen then? Reversal of revaluation shall take place, and if it exceeds the amount of the revaluation which was done before, so it shall be accounted for as an impairment loss into the income statement. For example, suppose on December 31st, 2012, the X Limited revalues the building again to find out that the fair value should be $160,000. Carrying value amount on December 31st, 2012, after 2 years, $190,000 minus the 2 years depreciation, $22,352, which amounts to $167,648. Now the carrying value exceeds the fair value by $7,648. So we discussed before that no impairment loss shall be arise, because now the fair value is more than the new revaluation. So it exceeds by $7,648. So we have the balance of $20,000 into the revaluation surplus account. Therefore no impairment shall be arised, only the revaluation shall be reversed. So what shall be the entry? Revaluation surplus debit, because the equity is being reduced by $7,648 and the asset account is being reduced by $7,648. So revaluation surplus debit and building account credit. Now that's all for today's lecture. If you have any question regarding today's lecture, you can put your question into the comment section and that shall be answered into the next videos. Till then, good luck.